Okay, welcome back, guys. Welcome back to another Not So Late Night show. Today we will be covering a REIT that I think it's familiar to us because it bears the name IGB itself, but it's not directly the same as the one that is currently listed in our stock exchange. So the rationale of the IPO of IGB Commercial REIT is that IGB Berhad, the sponsor or the current company that is also listed in the stock exchange, decided to actually apportion out of some of the commercial properties inside its portfolio and plans to list it as a REIT. And since properties majority or most of it are actually office building, hence it will be under a new name called IGB Commercial. So of course, we are familiar with IGB Hut and also IGB REIT, and IGB REIT has so far a very good track record in growing its distribution per unit and also the capital gains as well. If you have started to invest in the REIT back then when the IPO. So of course, the questions would be that will IGB Commercial REIT replicate or be as successful as IGB REIT, since they would be sharing the same sponsor and also the same REIT manager as well. So of course, before we going into the company of the night, here is just a snapshot of what we cover for our Premium Club members. So you definitely be invited to join our club, where we actually have a holistic kind of discussion, and also we will have certain monthly private sharing. So we talk about intrinsic value back then. And of course, there's also premium articles and premium analysis to our club members as well. And of course, if you are still unaware to what to invest, since that we are almost 50% into the second half of 2021, do also check out our Stock Plus 2021. And of course, if you're someone who plans to invest in certain kinds of themes, be it electric vehicles or semiconductor, we also have certain sharing on thematic events that you can actually deep dive into certain segments and find your next investment ideas as well. So we have covered electric vehicles, we are going to cover semiconductor, and e-commerce and cloud will actually be scheduled to happen in the next few months. So of course, we will be covering from the integrated device manufacturers, the fabless companies, until the very OSAT end companies as well. And of course, this is just a snapshot of what we have done previously for the EV sharing session, from lithium compounds to the auto parts and components, and even until the EV manufacturer as well. So of course, you will be enjoying a very holistic kind of discussion group, where we actually will bounce ideas and go into healthy discussions on certain stocks and certain themes. Of course, Stock Plus 2022 will be a continuous portion of what we will be offering for our Premium Club. And then apart from the premium videos and also the premium articles, you also get access to the thematic events and webinars as well. Right. So of course, that's about it. Before we go into IGB Commercial REIT, this is quick disclaimer. Do not take what we are going to share with you today as a decision to buy, sell, or hold any shares that we will be talking about. Please do further due diligence, and we wish you the very best in your next investing idea. So I'll pass it on to Chun Beng to actually talk deeper into what is IGB Commercial REIT all about. Is it the same as IGB REIT, and will it have a different kind of catalyst or risk that we need to know?
Yeah. So when we wanted to talk about IGB Commercial REIT, I think it's very natural that you will link it with IGB REITs, which is somewhere around the Mid-Valley City. And you are right, the listing of these REITs will be having some of the property coming from the Mid-Valley cities, which we will share the details later. But the next slide actually give you when is this IPO going to happen. So tentatively, it will be set at 30th of July, and it involves the listing of 2.31 billion unit, which will be listed on Bursa Main Market, right? So the next slide is giving you when we talk about mid-valley cities, maybe you're only familiar with the two shopping mall, which is the Mega Mall and also the Gardens malls. But actually the surrounding properties, actually they are a few, and it's mainly for commercial purpose, meaning it's for office, for the business owner to operate their business, right? So you can see within these small condensed so-called cities that connect between KL and also Selangor, there are about 7 that going to be listed under these IGB commercial REITs. So in the name of Central Point, North and South Tower, and also the Gardens North and South Tower, the Boulevard Properties, Menara IGB and IGB Annex, and the new one which is called the South Point Properties. So there will be 7 from the Mid Valley City under IGB Commercial REIT, and there will be another 3 coming from the KL side. So if you're familiar with Jalan Tun Razak, I mean, when you drive towards the ends, when you're reaching the KLCC area, probably you will see these 3 buildings nearby. So which is the G Tower, Menara Tan and Tan's, and also Hampshire Place. And this is the remaining 3 portfolio under IGB Commercial REIT, which make up about 10 properties will be grouped under this REIT, right? And then, so the next slide actually give you the overview on how this REIT structure works. It's quite typical, which the REIT itself will be in the middle, and then me and you as the unit holder will be the one putting in the money to subscribe to the unit, and we hope for some distribution by the end of the year. I mean, based on their performance, and then we can get some dividend. And beside that, another key role or key parties will be the REIT manager. I think something we wanted to highlight here is the REIT manager actually is the same management party that actually run the IGB REIT as well. So it's quite experienced, and of course, it actually tell you that this is the bunch of experienced people that is going to manage this IGB commercial REIT. And then the next slide actually give you the summary of all the 10 properties, and then it actually make up to about the value of 3.16 billions. And of course, some of it will be done through the IPO activities. So about 2.307 billion will be raised through the public listing, and the remaining one will be coming from some terms loan. So this is the summary of it. And then the next slide gives you a little bit deeper view of what is it about within the Mid Valley cities. So the 7 buildings, although it is connected in some way, but it's quite different. So you can see actually Menara IGB and IGB Annex is quite old. And fast forward to the new building, which is called the South Point Properties, only 2 years in operation. And this actually gives you some of the insights. So you can see South Point Properties, actually the occupancy rate is still quite low, mainly due to they only have 2 years in the market, and the recent 2 years are hit by the pandemics. And of course, those is performing the Center Point, North and South Tower, and also the Boulevard Properties. The Garden South Tower is also doing quite well, but Garden North Tower is slightly dropping if they compare to the previous year performance. So this is the 7 building within the Mid Valley cities. And then the next one is actually the summary of the 3 remaining building from the KL side, which one of it is the major contributor to this REIT, which is G Tower. Within G Tower, beside the office facility, they also offer hotel services. And of course, some of it actually go through some conversion, meaning they convert some of the hotel room, turn them into the office space. And then the rest is actually some of the data from Menara Tan and Tan, which is the oldest among all the building that hold by IGB commercial REITs is about 23 years old, and the occupancy rate is not that high, but of course Hempstead's Place is actually lower. The occupancy rate for 2020 is only about 62%. So this is the summary of the 10 building. And the next slide actually give you how this REIT, where they stand when they compare against other REITs in the markets. So you can see, if you talk about standalone office, by market cap, they are the largest. So because some of the other, for example, KLCC separate groups, even though they may be bigger in market cap, but then not every part of it are actually listed as a REIT. It's a combination of stock and so on. So this is an overview. Before that, I think you may be familiar with Central REIT, UOA REIT, but then when IGB commercial REIT come in, the 10 buildings actually build up the largest market cap if you compare amongst all the others office REIT in Malaysia. So the next one give you some of the insight when we talk about the occupancy. So all in all, it's about 76%. If you compare, I mean, you do an average of all the buildings, right? And then, of course, it's just hovering about 75 to 76. But something to take note is South Point is the one that still very, very low, even though it already improved from 20.6 as of the first year of operation, which is only about 4 to 5 months of operation in 2018. And then already managed to improve until 48.8% as of last year. And then, of course, G Tower give you a very high number, 85.5, right? But then it actually will be lower if you consider the converted space, which originally is a hotel room turned into office. Then the number might go down. So just some of the number that you should take note when you check out their annual reports. So this is just a number. So averagely about 75 to 76% of occupancy rates. And then the next slide actually tell you the biggest contributor is actually G Tower, which contribute about 21.2% in terms of gross rental income. And then the rest are mainly covered by the Gardens South and North Tower. And also you'll be surprised, the new one, which is South Point Properties, is also covering about 12.2%, 12.5%. So this is one of the highlight, I would say, some of the things that have quite a bit of potential in the future. But of course, you still need to take into consideration that some the remaining other buildings like Naratan and Tans and so on, they are quite old already in terms of the building age. It's about easily 18 to 20 years old. So it might impact the occupancy and it lead to some lower gross rental income in the future. But of course, South Point maybe is the one that able to balance the whole thing. That's why we should keep an eye on the occupancy rate in general, and you should look into the trends by each building if you have the chance to check out the whole analysis. And then moving on, we also wanted to share some of the information. Even though after this whole thing got listed, actually IGB Berhad will be remain as the biggest shareholder still at 50% if we talk about the maximum scenario. So inside their annual, in the IPO prospectus documents, they got state 2 scenario. So we are taking the maximum scenario as an example to show you, meaning most of the plan unit actually subscribed by all the parties, but there might be some possibility that it didn't subscribe 100%. And then if that is the case, IGB Berhad will be owning 52.7% rather than 50%. But all in all, they will be owning half of it. I mean, even though after this IPO activity. And then moving to the next slide is something that we always will check on if we wanted to look into a REIT, which is the weighted average lease expiry, or in short form, usually you see it, the WALE. Their views is actually 1.8 years. In my opinion, it's a little bit short because for office building, you tend to be more stable if you compare with retail REITs. So for example, those shopping mall, you got different brand, and then the turnover rate may be quite fast. And then 1.8 year maybe is the things that are acceptable, but then for office, usually the contract will be slightly longer. But nevertheless, the whole the whole number of it is not very concentrated in single financial year, so it's quite well spread across lah. So the worst case is if it happened in 2022, meaning all of the people didn't continue to renew the contracts, meaning 32.8% of it will be gone. So this is just some of the number to take note lah. And then moving on is some of the tenancy profile, and then it's actually mainly covered by the consultancy, marketing and business services, and also IT and communication, and followed by oil and gas. So this is all the major industry that actually occupied the 10 buildings under IGB commercial REITs. And I'll pass on to Jupan to talk about some of the numbers and the financial information.
Okay, thanks, Beng. So I think, given that the fact that IGB commercial REIT is some sort like something a portion of IGB Berhad, so a lot of information or data or numbers that you can get from the IPO prospectus, it's a little bit simplified because since it's not a totally new kind of listing, so some of the information or some of the numbers is actually going to be carried over or portioned out from IGB Berhad. So take for example the pro forma consolidated financial position. You can see that the total non-current assets is actually the amount of the total portfolio properties that is going to be portioned out and under together for IGB commercial REIT. It turns out to be around 3.16 billion ringgit, right? And then of course there will be some contribution from the current assets, but overall not as huge as the non-current assets, which is mainly the investment properties. Of course, when you actually want to launch an IPO or finance purchase of 10 properties, it's going to call for some fund or some capital to actually enable this purchase, right? So a huge chunk of it will come from the unit holders fund, which is 2.3 billion ringgit, and then there will be a small borrowing or say a small medium term note portion of around 850 million ringgit, right? So all in all, it adds up together to make up around 3.2 billion tallies with your total assets. Of course, you take the amount of units of that they plan to list on the stock exchange, and then you calculate back the net asset value of the total so-called total unit holders funds minus of the liabilities, you will actually get pretty much an NAV of 1 ringgit per unit. So the REIT is going to an IPO at a price to book ratio of 1 times at 1 ringgit a share, and a huge part of it will come from unit holders fund, which we will talk about more in detail later. So you can see that the non-current liabilities will actually be made out of a medium-term note totaling around 850 million. So, of course, whenever we talk about REIT, whenever a REIT takes on debts, we want to ensure that it is not above the mandatory gearing level. So, of course, if you look at the amount of medium-term notes that is going to make up actually 100% of the debt is going to be just around 850 million ringgit. And then if you back calculate and divide it with the unit holders fund, the gearing ratio is going to be particularly low lah. So it's just around 26.3%, much lower than the 50% threshold being set by the Malaysian securities that is implemented to ensure that at any one time Malaysia REITs cannot exceed the gearing limit or gearing ratio of 50%. Right? So this is particularly a very low geared rate. And then if you look at the so-called trailing 3 years performance, you would notice that actually the revenue has been on a dipping trend. So from fiscal year 2018, it managed to get around 204 million ringgit in terms of the total revenue. Come 2009, it actually went down to 200 million. And then, of course, in fiscal year 2020, due to the pandemic, due to the unprecedented effects brought by pandemic, of course, the revenue continued to shrink to 194 million, right? So, of course, it is still a healthy kind of performance if you look at the way that it hasn't really slumped into any losses. But as an investor, you might want to actually take note of whether there is a potential reversal in the total revenue, whether it will kickstart certain kind of growth momentum come fiscal year 2021 and moving forward. But on that front, at least some kind of consolidation that you can have is that during fiscal year 2020, they actually controlled their costs to ensure that the net property income is actually 133 million, which is what they actually achieved for in fiscal year 2019. So you can actually take it as a both good point and bad point, that even though at the shrinking revenue due to the pandemic, at least it managed to improve their cost control measures, right? And of course, if you look at what they also wanted to share with prospective shareholders or potential subscribers to their IPO, the forecast for 2021 wouldn't be a good year also. They project to actually just hit around 144 million due to the prolonged effects from the pandemic. Of course, if you are from Malaysia or you are aware of where Malaysia is currently right now in terms of handling the pandemic, you would notice that it's still some sort, it still requires certain kinds of control in terms of the movement control order, and also ensuring that the cases of the COVID pandemic can continue to go lower before you would actually pinpoint a more substantial or more predictable reopening of the economy, right? So due to that, small, medium enterprises or even companies would also relook into their tenancy agreements in terms of office spaces, and hence the effects from pandemic will definitely carry through and carry forward to fiscal year 2021. And of course, a more subdued total revenue will actually impact the net property income and also the distributed income as well, right? But based on what they think that they would achieve, and you back calculate back with the IPO price of 1 ringgit a share, you would actually be getting a projected or forecasted distribution per unit of 3.9 cents, which translates to about 3.9% in terms of the distribution yield. So we will talk more about the valuation later, but on paper, it looks like it is a good deal, bearing that you will still be getting a forecasted 3.9% based on the worst case scenario, based on the REIT that is still trying to recover from what we call a pandemic effect. Then, of course, there will be some important IPO details that we also need to understand before we actually rush into any kind of subscription of the IPO shares or IPO units. So, it is also mentioned that that there will be a listing of 2.31 billion units of REIT units onto the Bursa Malaysia exchange. And if you dig down deeper, actually, out of these 2.31 billion units, around 945 million units is actually the restricted offering. And this restricted offering is actually a portion out to your existing IGB Berhad shareholder. So existing IGB Berhad shareholders actually get a more guaranteed approach into subscribing to IGB commercial REITs unit, right? Compared to the so-called traditional route or the other route where, in retail investors who are not currently IGB Berhad shareholders are trying to, apply for IGB commercial REITs units via the traditional usual IPO route. Chances are you might get and you might not get it if you are using that route. But if you are an IGB Berhad shareholder, you are almost guaranteed if you actually choose to take up the restricted offering. So out of this restricted offering, you actually get an allocation of 2 IGB commercial REIT units for every 5 IGB shares that you hold. So that translates to around 378 million units. And if you do actually subscribe to these 2 units of IGB commercial REIT, based on every 5 units of IGB Berhad, you actually get 3 free dividend or distribution in specie of IGB commercial REIT. So in actual terms, you're actually getting 5 unit of IGB commercial REIT. 2 you need to pay a price to buy it, and 3 shares that you actually get it for free should you actually choose to subscribe to it. And then only the balance of 282 million gets into institutional offering as well. So here's a little bit more graphical analogy. Say, example, if a shareholder holds 100 shares of IGB Berhad, he will actually be entitled to 40 of the restricted offering shares of IGB commercial REIT. And if he does actually subscribe to the 40 restricted offering units, he actually gets an additional 60 units of IGB commercial REIT as a distribution in specie, meaning to say that he will get the balance 60 for free if he chooses to actually pay for the 40 restricted offering units, right? So here you have it. If you are an IGB Berhad shareholder, you actually have 3 options. Option 1 is to subscribe all, pay for 40 units of it and get 60 units for free. And then if you don't want to exercise 100% of your right, which is the 40 units, you can actually choose to exercise maybe 20 units of it, right? So it's not to say that you have to actually subscribe to all. You can actually partially subscribe to it, or you can choose to not subscribe to it. Means that you actually be losing out on the opportunity to subscribe or to get some sort of exposure to the IGB commercial REIT. Right? So let's do a little bit of maths. If you actually do choose to subscribe or take up the restricted offering of the units of IGB commercial REIT, you actually need to pay 40 ringgit if you have 100 IGB Berhad shares. So this is the 40 units that you need to pay, you need to accept. So that amounts to 40 ringgit, and you will actually get 40 ringgit for 40 shares of IGB commercial REIT. And apart from that, you get 60 shares of IGB commercial REIT as a dividend in specie. So your weighted average cost by having 100 units of this as well, 40 of it, you actually pay 40 ringgit to get it, but 60 shares of 60 units is actually free because you actually subscribe to the 40 units. Your weighted average cost is actually going to be 40 cents per unit of IGB commercial REIT. So in comparison to a retail investor who does not have IGB Berhad shares and do not have this kind of so-called restricted offering and also the distribution in specie, they will actually be buying 1 ringgit per unit of IGB commercial REIT at the IPO price. So there will be some sort of benefit or advantage for an IGB Berhad shareholder to consider subscribing to the restricted offering units of IGB commercial REIT Berhad. So this is on paper that I think normal retail investors should take note of. You are actually buying 1 unit at 1 ringgit, where else an existing IGB Berhad shareholder is going to get at a weighted average price of 40 cents per unit. So there will be a 60% premium, relative premium that you're paying more compared to an existing IGB Berhad shareholder. And of course, that doesn't mean that the IGB Berhad shareholders are straight away guaranteed some sort of winnings or capital gains when IGB commercial REIT actually lists on the stock exchange. Do note that since that IGB commercial REIT is going to apportion some of the properties which are currently inside IGB Berhad's portfolio, of course, since the news of it came out, you can see that the share price of IGB Berhad actually corrected downwards from roughly 2 ringgit 80 cents down to 2 ringgit 50 cents. Of course, those who have invested in IGB Berhad for quite some time, this drop would still meant that you are still sitting on some sort of capital gains. But of course, for those who actually invested back in a few months ago, you might actually be sitting or looking at some kind of unrealized losses. So the key note here, or the key thing here, is that you should actually compare whether the unrealized losses can actually be adjusted back, or when you actually see your IGB commercial REIT IPO price or portion coming in, whether these two actually can even up and give you a weighted average kind of capital gains or not. So I think there are 2 points or 2 sides you need to see from this. For the traditional route of applying for the IPO unit of IGB commercial REIT, you're actually paying 60 cents more compared to an IGB Berhad shareholder. And for IGB Berhad shareholder, you need to actually consider the gains from IGB commercial REIT might actually be used to compensate for the potential unrealized losses that you are having for holding on to IGB Berhad as of today, if you have bought it above 2 ringgit and 40 cents and above. So I would maybe pass it to Chun Bing first to give a little bit of his opinion and verdict before I round it up for my opinion as well. You need to unmute.
Yeah, I think of course IGB REITs or has been able to demonstrate their capability of increasing the valuation or the share price performance of for the 2 malls, which is technically grouped under IGB REITs. So over the year, if you are the early investor of IGB REITs, I think you'll be seeing a lot of capital gains plus some dividend returns. So I think this is some of the plus point when we talk about IGB commercial REIT. On the other hand, of course, I think Mid Valley City is a very strategic area where it's actually connecting both KL and also Selangor. And of course, the mall itself will give some plus point for the business owner to set up their office there, right? And right now, even with the new LRT that connect through the KL Eco Cities and over one bridge, they can walk to the whole area that is under the Mid Valley City portion. All these things is a plus point, but of course, you should always take note, this is not a mall. Ultimately, it's an office. And then there will be a lot of different areas also offering a new business center. For example, you have a new one, a lot of construction going on in Bukit Jalil. And also in Damansara cities, there also got the so-called another pavilion project going on. So all this is act as a track to all these officers, because people might just move to a newer place and they might give them a better rate. Not forgetting you still got TRX. So when you see how well they are performing in the past maybe 5 to 10 years in these Mid Valley City areas, might not be true if you try to bring in other projects that are happening on the other side. But this is some of the opinion. And of course, office alone, only the South Point one is quite new. The rest is about 10 years and above. And when the building get older and older, and of course most of them are leasehold, those also will impact some of the value coming down the road. So these are some of the information you should take note. But of course, some of the scientific way is you do some comparison with their peers, with some other REITs, and see where they stand based on their so-called predicted result for 2021.
Okay, So we will take a look at the basic comparisons against the other so-called commercial REITs or the more well-known retail REITs as well. So since you're actually investing into a potential REIT, so might as well compare it with other REITs and see where are they varying in terms of so many kinds of aspects and metrics, right? So we talk about that it's going to IPO at 1 ringgit a share or 1 ringgit a unit, and based on the forecasted 2021 performance, it's going to get you around 3.9% distribution yield, right? So not the greatest, but you might actually argue distribution yield is a function of distribution and also over the unit price, right? So for some of the other REITs out there that you might see have a higher distribution yield, you can actually estimate or dig deeper into their annual reports to see that actually they are not performing that well, and hence the unit price is actually going down faster than the underperforming unit price, underperforming distribution, right? So keep that in note that there might be some kind of growth prospect for IGB commercial REIT. In terms of price to book, you can see that there are some REITs listed here having a depressed price to book ratio, meaning to say also the unit price or the REIT is actually not gaining some kind of traction or momentum that the public is actually willing to buy the REIT or invest into a REIT at the higher price to book ratio. So relatively from here, the one most expensive than IGB commercial REIT would be IGB REIT, which is currently at 1.6 times price to book ratio. And of course, on terms of the DPU, would see that a lot of it actually getting hit hard by the pandemic. It's up to our so-called study to guesstimate or to determine whether which REIT would actually become or emerge as a winner when the so-called reopening and also the MCO comes to an end. Some of the REITs will recover faster, some of the REITs will actually continue to suffer. And of course, I think one other so-called metric that we need to also drill down is the property yield, which actually shows us how much the property is earning based on the net property income it's fetching versus the valuation of itself. So this is totally unrelated to the unit price. This is basically just gauging the properties inside the REIT, whether the REIT is actually having good properties, good quality properties, which is actually yielding or collecting much more net property income on top of the appraised value of it. So this is also something you need to take note of. Of course, there are some REITs which are not really hitting the marks in terms of the property yield. Some of the REITs are actually showing very, very strong property yield. And of course, in terms of gearing, I would say that they are rather in the middle for IGB commercial REIT, around 26%. You have REITs like Sunway REIT hitting close to 50 times or 50% at 44.7%, and the other low gearing REITs like KLCC Property and also Your Tower REIT. Right, so before we actually end the sharing, of course, if you still find it tough to find good dividend stocks to invest, we do also have a certain kind of masterclass or sharing session where we actually teach you different methods or different criteria to screen through to find your next potential dividend stocks. We might actually also be using some of the real life companies like the commercial REIT, IGB REITs to actually show you real life case studies to pinpoint which are the REITs that are so-called steady, worthy to invest, and those REITs that are actually you might need to avoid. So this also applies to normal companies and also banks and insurance as well. And of course, it will be a one-time payment for a free for life updates if there is any updates required for the sharing. Of course, last but not least, before we actually end, I would say I would agree with what Jermaine shared just now. Of course, it's the properties are mostly situated in Mid-Valley City. It's a good and strategic area. But I think one thing that you need to keep remember is that there's an ongoing office glut in Malaysia, and not to say that commercial REITs won't do well, but you need to actually come up with a very strong thesis that why that so many other commercial REITs in Malaysia are facing certain kinds of headwind, and what IGB commercial REIT has on its card to be different from the other commercial REITs, right? And of course, since you already know that the forecasted 2021 results would still be lower than what it has achieved in 2020, if you are still not confident or comfortable with the so-called prolonged effects from the pandemic, might as well just wait for things to recover or show some kind of rebound in terms of the fundamentals before you actually consider investing in the REIT, if it's just a REIT that suits to your so-called risk profile and also an analysis point of view is still a solid REIT, right? But that's all for us. I think it's a good and reputable REIT being controlled by management that we all know and a sound company. But just because timing right now due to the prolonged effects from the pandemic, you still need to actually consider that point before you actually do any kinds of investment decisions. So I think that's about it for today. Hopefully this will help you to study further on what aspect that you need to be clearer before you actually choose to invest or stay away or wait when it comes to your next IPO stock. And that is all from us today. So take care, and we see you in the next episode. Bye bye.